Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss Social Security Fairness Act, market cycles and initial public offerings, Social Security earnings test, and a look at the Plan Solutions Incorporated Office Bulletin Board. Mr. Armour, how are we, good sir?
Doing well, yeah. Kind of the quiet before the storm as we prepare for tax season. I think we got all of our organizers and everything out, and now we're just waiting for all the tax forms to roll in, and I'm sure we'll be real busy within the next couple weeks.
Yes, sir. As of the release of this episode, boy, we are pretty much through the month of January. It's just flying by. So yeah, tax season just around the corner. But we're going to dive into some great topics. So let's talk Social Security's Fairness Act update, the elimination of WEP and GPO. Little more on what the Social Security Fairness Act is, and then let's dig into what WEP and GPO are.
Yeah, so we talked about this recently, but we thought it was worth expanding upon, right? We were kind of surprised. I mean, the Social Security Fairness Act, this is this concept of eliminating the windfall elimination provision and the government pension offset has been brought up a number of times and has never passed. And so, thought, well, this is just going to happen again. It won't go anywhere. But lo and behold, it passed Congress and President Biden signed it. So it's now going into effect. And so, we're kind of scrambling now to play catch up to make sure that people that may be impacted are aware of what these changes are.
Yeah.
Basically, the idea is historically taxpayers who are classified as either non-covered employees, which typically were state and local government employees, as well as a small number of federal employees who began working after 1984, may have not paid into Social Security, not paid the Social Security taxes that are, deducted from our paychecks. Versus you had covered employees, which is most people that have Social Security taxes withheld. And so then those non-covered employees, especially those that had zero or maybe had very few years where they were paying in, they were subject to these fairly complicated formulas that determined what benefit, if any, they would get from Social Security.
Right.
And it basically had to do with the number of years of substantial earnings they had where they paid into Social Security. So maybe a previous job before they got this, non-covered job. And then how much their pension was from their government work, and if they had very few years of substantial service, or if they had a really large pension, it could be that their Social Security benefits were eliminated entirely. But in many cases, you saw where they were reduced by a certain portion based on this complicated formula. And so now with the Social Security Fairness Act passing, really it's just going to remove all those complicated formulas. They will no longer apply. And so it will go back to whatever an individual sees on their Social Security statement based on what they've paid in, that will be their benefit. There won't be this question of how much may it be reduced for years of non-covered employment and the amount of their pension, et cetera. That's all out the window.
Yeah, well, I mean, a good sign, and definitely, as we've discussed, for those listening, we're in our 10th year with the podcast, and so this has been a topic that has come up quite a bit. And every time you say there's a much more simpler formula, it always sounds like a good thing for everybody to be able to understand. So, what are we really seeing with the elimination of WEP and GPO as far as monthly increases, and when is that supposed to take effect?
Yeah, so I think it's going to be distributed pretty broadly based on individual circumstances. The Social Security Administration did give some statistics. They said On average, the monthly Social Security benefits will increase between $360 and $450 for those affected. But of course, that's going to include people where maybe it has very little impact at all, because they had a fairly small amount of period of non-covered service. And as we also said, for some people, their benefits were entirely eliminated, right? So it could have a much bigger impact. So I don't know that that average is extremely helpful. But they did say that, they expect that there'll be 2.5 million taxpayers
Hmm.
that are already collecting Social Security that will get some benefit, not to mention the people going forward who are just now becoming eligible or maybe eligible in a few years. And so, that's a big number. And I think here in California, we'll see an outsized, percentage of that just based on how this program has worked. So the Social Security, if people are already claiming Social Security, they're going back and they're working through the calculations. This bill is retroactive to January 1st of 2024. So anyone who hasn't been receiving the full benefit will be due for a lump sum payment to basically catch them up, in addition to additional benefits going forward.
So I want to dig into WEP first, windfall elimination provision. Who was it initially designed for?
Well, in essence, the idea was, okay, if you're not paying into Social Security benefits, it doesn't make sense that you would get the full benefits, right? You're not contributing to the system.
Sure.
Why should you get to draw on the system? But of course, as we mentioned, there's a lot of people that are kind of in between there, right? They did contribute, and then maybe we're in a situation where they weren't receiving anything, which also didn't make sense. So it was a messy situation where a one size fits all equation or formula, was maybe going to be fair for some, but not fair for others, and so they kind of just threw the whole thing out because of that. But the windfall elimination provision was really for those that did not pay into Social Security, but maybe they paid in enough that they got their 10 quarters early in their working years, but then didn't pay in for quite a few years while they were working for a government agency. They were receiving a large pension, which is basically designed to cover the anti-poverty provisions in old age that Social Security is designed to offset. So that windfall elimination, reduced or eliminated their payout based on that formula. And then you had the government pension offset, which kind of went together with the windfall elimination provision. But instead of looking at the individual's earning record for Social Security, it looked at their spouse's record. Because we do have the ability to claim spousal benefits. And a lot of times people can look at it and say, which is better, right? Is it, do you claim spousal benefits? Do you claim on your own record? Or if your spouse has passed, do you claim survivor's benefits on their record? Or do you claim on your own record? So the government pension offset kind of went with the windfall elimination provision to have a similar impact, right? To say, okay, if someone didn't pay into Social Security and maybe they paid nothing in, they then can't come in and get half of their spouse's benefits just because their spouse paid in, because they were covered. And really Social Security originally being designed to be an anti-poverty program. The idea was if they've worked all these years and they've earned pension credits, they're not going to be in poverty. They're going to be getting those pension payments. But that was also eliminated. So now, it'll be the question of, okay, for someone who's impacted, is it better for them to claim on their own record? Could they potentially claim spousal benefits, or maybe even go back and claim survivor benefits if their spouse has passed away, starting on January 1st, 2024?
Yeah, well, it's definitely an interesting thing. And if somebody really needs to go through a review process of this, I know that you folks are always available. But what are some other resources? I know we have a website. We'll put it in the podcast description. That link there, because even though it's been simplified, there still is some confusing aspects to it that always seem to be present for sure.
Yeah, and we have some information, but I'm sure there will be more that will be coming to clarify. But the current understanding is if you're already receiving Social Security benefits, but they were reduced because of the windfall elimination provision, you don't need to do anything. The Social Security has that information. They will rework the calculations and you'll get that lump sum payment plus an increased monthly benefit going forward. If you're not claiming Social Security benefits, maybe because you realize you weren't going to get any benefits, so why apply? Or maybe if you had the opportunity of spousal or survivor benefits or something like that that previously wasn't an option, but now may be, then really you want to either set up an appointment at your local Social Security office to talk through your specific situation and your options, or visit ssa.gov, the Social Security website, and go through their portal. And as you said, there's a website where they if you search under the Social Security Administration, the Social Security Fairness Act, there is a page there where they're kind of updating information as new information becomes available.
Yes, sir. And that link is in the podcast description, as I mentioned. All right, let's jump over to market cycles in initial public offerings, IPOs. We've been talking about the U.S. stock market. It's posted 2 consecutive years of strong returns following the losses in 2022. But it didn't it didn't necessarily show a rebound in the economy per se. We had that period of recession. So, what are we wanting people to understand about market cycles and really IPOs? We've touched on IPOs in the past, but sometimes they're a little bit confusing as well.
Yeah, market cycles, tend to have different phases as we've talked about, right? And our view is 2022 was the downturn, the down phase. 2023 was the recovery. 2024, potentially the first year of a new growth phase. But I know a lot of people, they see the strong returns in 2023 and 2024, and they think, oh my gosh, the market's hitting new highs. Maybe it's due for a downturn. And what we tend to do is look at different signs of where we are in the cycle. And there's a lot of different things, pieces of data that could be used. But for example, even though we didn't technically go into a recession in 2022, we view it as that was the down year, and partly it's because of the way the market responded with the market being down significantly. But the other piece to that is initial public offerings, right? Companies first coming to market completely dried up in
Mhm.
2022, and since then there's been very, very few. And that is part of the cycle. It typically happens a little later in the growth cycle when the markets are strong. And it's an important part of the functioning of the financial markets because, one of the main benefits of the financial markets is to provide new funding to these smaller, typically high growth companies that get to the point where they just can't privately raise enough money to keep funding that growth cycle.
Right.
So they need to go to the public markets and go public and issue a bunch of shares and bring in all of that money that they can then use to fund growth. Of course, it also brings an opportunity for a lot of the early employees or early investors where now that company is becoming worth a significant portion of their overall net worth. It gives them the opportunity to be able to liquidate some of those holdings and maybe diversify or do other things with those funds.
Is the lack of new IPOs just a sign of a lack of confidence in the economy and people, holding on to cash?
Well, I think it's really just a sign of the cycle, right? I mean, this is, IPOs will go through periods where they're very strong and there's a lot of money flowing in and a lot of optimism. And as with most things in the markets, it gets overdone.
Hmm.
And then because there's, just so much funding, I mean, pre 2022, there was just a huge amount of funding. And maybe some of it, not so smart. It was getting to the point where there was so much money chasing after, these private equity, venture capital, IPO potential deals, that it was getting to the point where there was very little due diligence being done, right? I mean, companies had so much money to deploy really they were just begging for deals instead of going to the companies and doing the due diligence and say, okay, is this a good deal, is this going to pay off? And so it did get very frothy and almost you could argue somewhat of a bubble.
Hmm.
So even though 2022 was a down year for the stock market but wasn't that bad compared to a lot of historical downturns, it was really bad in the IPO market. It was a very big adjustment. which makes sense. The pendulum swings too far one direction, right? It swings way back the other direction. But now that early stage investing has started to pick up. But a big part of that is those early stage investors need to have an exit at some point, right? They need to have a point where they're going to be able to sell those shares for profit. And basically, what we're arguing here is, we probably will see another strong IPO cycle at some point in the near future. And there's, a lot of big name companies that, have been waiting and waiting to go public that could get people really excited.
Mm.
And that, often then leads to maybe a little bit of irrational exuberance, really strong markets. They get ahead of themselves, and then we go, through the cycle again, right? Then we have a downturn, things normalize, and we start over. But the fact that we haven't even seen that IPO cycle yet tells us we probably still have a while in this current growth phase.
What about the I don't know that it's necessarily the opposite of what about in these market cycles? Is it even a common practice or occurrence for a company to go from public back to private?
It is, although that often happens at the opposite end of the cycle, right?
Huh.
If a company is public, they're struggling, their stock price is down. It may make sense for private investors to raise money and actually buy them out and take them back private, often in more of kind of a turnaround type situation where they think they can improve the operations of the company. That the overall market environment will improve as well, making it easier for the company to return to profitability. And then in many cases, those private companies, once we go full cycle, or maybe we go through, another cycle and a half or something like that, when the IPO market's strong again, they'll bring those companies back public now that the numbers and the health of the company look a lot stronger.
Okay, thank you. Yeah, I was curious about that. Anything you want to add before we jump to Social Security earnings test?
Well, just that, the IPO cycle is just one piece of information you would use to determine, where we are in the market cycle. But I think it's an important one for us to focus on, and I think it's something people can put in the back of their mind that, okay, we're in a pretty strong growth cycle, and that's probably likely to continue until we see a new IPO cycle. But when that IPO cycle is running really hot and really strong, then that's when maybe you should start getting nervous.
Yeah, all right. Well, let's take a look at Social Security earnings test. The retirement earnings test applies to individuals who apply for Social Security benefits before the full retirement age. Now, we've talked about this quite a few times, as far as people that might apply before full retirement age. But what really is the earnings test? How does somebody weigh that out?
Yeah, so you can apply for Social Security retirement benefits as early as age 62. But for most people that are now becoming eligible, their full retirement age is going to be somewhere, 67 in several months to 68 years old. And so if they're applying early, you can do that. But if you still have earnings, and this means actual, earnings from work, right? Not investment interest or dividends or capital gains or pension or things like that, but actually, from physically working, if your earnings exceed a certain limit, then your Social Security benefit is reduced.
Mm.
And so for 2025, that earnings limit went up to $23,400. So just shy of about $2,000 a month that you can earn, still collect your Social Security check and not have any adjustment. But if you end up working more and you go over that amount, then there's a formula where they start reducing the Social Security benefit. Basically, for every $2 over that 23,400 that you earn, your Social Security benefits will be reduced by $1.
Mm.
So that's something that people at least want to be aware of. Again, if for every $2 that you earn, you lose $1 in Social Security, well, you're still $2 ahead, right? So in many cases, people may choose if they like what they're doing, or if they have the opportunity maybe to continue to work and earn past that 23,400 mark, because they will still come out ahead. The other misnomer is a lot of people think that means that your Social Security benefits are lost.
Right.
They're not lost. What they do is they recalculate the amount that is deducted. They recalculate it to assume that you took it later. So it'll actually increase your future benefits as if you delayed them, right? Because every year, if you collect at age 62, you'll get a certain amount. If you would have waited to 63, you'd get more. Well, in this case, the amount that you did not receive will actually be included in that calculation, and you'll get more down the road.
When you mentioned the $23,400 threshold, is that pre-tax or post-tax?
That's pre-tax, yeah. So gross earnings before any deductions and things are taken out. Um, and the other thing to consider here that's a little bit tricky. So, let's say you're age 62, you start drawing Social Security, you don't plan on working a lot, but then, you get a contractor job or something, and it's a good opportunity. So you keep working and you go over that threshold. Um, well, for that first year, you're going to have those earnings, plus you're going to get your full Social Security. But when you report those earnings on your tax return, that's when Social Security is going to go in and make those adjustments. And so they're going to go in and say, well, actually, you should not have received this much, so you owe it back. So we're going to stop paying you until, that amount has been deducted. And so people just need to be aware because it can create some real cash flow issues. You can have, at the age of 62, you could be working, earning a bunch of money, getting Social Security, things are good. Maybe, you're spending the money going on vacation, doing this because you have this extra cash flow. Then at age 63, that opportunity to work is now gone, right? So you don't have those extra earnings. And now your Social Security is you're not getting paid your Social Security for a number of months or even for the year because you have to pay back all those benefits, right? So it can create some real cash flow issues. So people need to be aware if you're going over that Social Security earnings limit, be prepared that you're going to have to pay that money back and maybe even want to set it aside so that you have it so you can offset the change in cash flow in the future months or years.
Yes, sir. All right. Well, let's jump on over to the Plan Solutions Incorporated Office Bulletin Board. We've got one item pinned up there.
Yeah, so we've talked about, when different, tax forms and things will be released and how some of them come out at different times. But in some cases, people may not be aware that they may need to file some of those tax forms for others. Um, so there's a couple that are due January 31st that people should be aware of. The first is Form 1099 NEC, which basically, if you run a business and you paid an individual, now this is someone who's not a corporation or some other type of entity, but just, an individual. If you paid them more than $600 for the year, then you need to report that to them on a 1099 NEC, right? So this is like if you're running a small business or, you have some contract labor or the other one that we see that actually qualifies that people are doing like Airbnb or
Mm.
Verbo or something like that, right? That typically doesn't get reported as a rental activity. It's reported more as a small business.
Hmm.
And if you have a handyman or maybe somebody that, helps with some projects and you're deducting that as contract labor, then you want to send that 1099 for those $600 to make sure that it's covered. And then, it'll match up, what you're reporting will match up with the expenses that you claim on your Schedule C. If you don't, send out those forms, there can be daily penalties that'll accrue. Never seen it enforced, but it is technically part of the law. Always makes me nervous when people ignore something just because it hasn't been a focus of the IRS, because often what happens if it goes on too long and too many people are ignoring it, then that's when it'll suddenly become a priority of the IRS, and you want to make sure that you followed those rules.
Right, absolutely. Well, you also mentioned that some taxpayers may need to file Form 1098, which is also due by January 31st.
Yes, so this is in the case of a seller financed mortgage. So,
Okay.
for an example, let's say a taxpayer sells real estate, but instead of the buyer, putting in a down payment and borrowing, maybe the buyer gives them a down payment and they carry the mortgage, right? So they're kind of the mortgage holder going forward, and typically that can in some cases be advantageous to the seller because you can report it using the installment method and stretch out the taxes. So It's not real common, but it is something that you see a fair amount. And so in that case, the person holding the mortgage needs to file a Form 1098 where they're reporting to the buyer the amount of mortgage interest they received. And really the IRS uses that, to calculate, okay, the seller can deduct a certain amount of mortgage interest, and they want to see that the buyer is reporting that as interest income, right? That the two match up. And so that's partly how it's done is the buyer, really has the responsibility for tracking the payments, how much is interest, how much is principal, and reporting that to the seller so that it syncs up. So yeah, there can be some other forms that are pretty uncommon, but those are the two most common ones that we see. So if someone has that situation, they should, if we're not already on top of it, which we do track a lot of these, they should, make sure to contact our office so that we can make preparations to make sure they're adhering to the law and that those forms are filed ideally by the January 31st deadline.
Yes, sir. Yes, sir. Well, anything else you'd like to add before we wrap up this edition of the Plan Solutions Incorporated podcast?
Well, just as we transition into tax season, if people have questions as they're gathering their information, things like that, obviously feel free to reach out. I know some people are kind of preemptively getting things on the schedule, so that's great too. So yeah, we're ready to go. Like I said, it's kind of the calm before the storm, but we're happy to get working for those that want to get their filings in early.
Yes, sir. Absolutely. Well, we thank you all for listening to the podcast. Please subscribe if it's your first time, Apple Podcasts, Spotify, or you can go to our YouTube channel, youtube.com/@PlanSolutions, and you can watch along to the personal financial review, the content that Mr. Armour and I discuss here on the podcast, which if you're not subscribed to that yet, you can simply send Katie an email and get subscribed today. It's KATIE@plansolutions.com.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.